And welcome back to America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker and Chaz Price. Really do appreciate you joining us today. 419-794-3030 is the phone number. The website, arhq.com. You know, it seems like it's a full-time job, guys, to keep up with all the changes our politicians are making to retirement planning. The Biden administration now has a proposal to change the tax status of the 401k. He wants to do a flat 26% tax across the board, no matter what bracket you're in, which would help those in lower brackets, but hurt those in higher brackets. Guys, can you tell us what this means? And do you think this is going to discourage people from taking advantage of their 401k?
Yeah, I mean, if you look at it, will Biden's proposed 401k rule change be a good or bad thing? I guess it depends on, where you're at in the income bracket standpoint. So if we look at this and we kind of look at what this means, the Biden administration's the proposal would change the current 401k tax deductions into a tax credit. Whereas a tax deduction is going to reduce your taxable income, a tax credit directly reduces your tax liability via dollar-for-dollar reduction of the taxes that you own. And here's why that matters. So if you're in the 37% tax bracket and you contribute $10,000 to your 401k plan, you're entitled to a $3,700 tax deduction currently. But those in the lowest 10% bracket, they only receive a tax deduction of $1,000 for the same $10,000 contribution. The Biden proposal will adjust that to $2,600 tax credit for any taxpayer making a $10,000 contribution regardless of the tax bracket. So again, those lower income earners are going to get more tax money back with the tax credit than the higher income earners. And, the challenge is if you look at a 401k in general, we've been talking about this for years. A 401k is a flawed investment vehicle for many people who are financially successful. So after, almost 30 years of doing this, I have yet to have somebody come into my office and say, hey, when we retire, we're just going to sit on the porch and watch the cars go by. Most of the retirees we work with are spending the same or even more income in retirement time. So the thought process of save money today because you'll pay less taxes in retirement oftentimes is not true. In fact, for those of you that are out there, that have been working towards saving for your future, if you think that your family's individual tax rates could go up in the future because of the out-of-control spending that this and the previous administrations have been doing, then you want to look at trying to shift more money into the tax-free category. So on the 401k, a couple things. If there's a company match, to me, it's free money. You might as well take advantage of what free money is available. With the Secure Act 2.0 that was passed in December of last year, there's also some more flexibility in contributions. There's also higher catch-up provisions. There's also the ability where you could potentially put money into the tax-free side. So if you haven't looked into a Roth 401k, that could be another option as well. But, here's just one more example of where they're going to penalize you to save and invest for your future. So that high-income earner, instead of getting, that 37% reduction would be knocked down to 26%. I'm sure some people say, well, the rich deserve to pay more of their fair share. But, in turn, when that person takes money out, under the current tax law, they're going to pay taxes as an ordinary income tax bracket. So if their tax bracket's 37% or whatever that tax bracket goes to in the future, then they're going to get a lower tax deduction in the beginning to potentially pay higher taxes later on in the future when they take withdrawals out. And then also could potentially even pay more taxes because that money is grown, hopefully, over the years. And so now they're going to pay taxes on a bigger balance. And then in addition to that, the government's going to come after any money that's left over for their kids and grandkids if they leave money from their retirement account to their loved ones. So just another disaster that this administration continues to make. And I think it's a matter of why you need to look at your situation. And one of the keys to building wealth long-term is to keep the government away from your money.
Yeah.
So whether it's this administration, the previous administration, they've all been spending out of control money, and attacking your retirement account could be the simple solution because it's the biggest or second biggest asset that they own. Now, here's the other thing that this administration wants to do is, again, going back to the biggest or second biggest asset, attacking that. They're also looking at attacking homeowners too, right? So the new proposal is they're looking at making those with good credit pay more for a mortgage, and giving those with lower credit a benefit and an incentive to go out and get a home. So the 1 and 2 biggest assets that a family typically owns is under attack, but there's things that you can do about it. And again, the strategy is to try to keep the government away from your money. I don't know. What are your thoughts, Chas?
I agree. I think I was, interested, or I'm glad you said not this administration, but previous administrations, because when you look at the national debt, I think we're looking at over $31 trillion in national debt, and that just didn't happen all in the last 4 years or so. But what's interesting is that when you look at the chart of the national debt, it just skyrockets, almost parabolic in the last 10 or 15. So I think there is this fundamental or philosophical shift from just where it was previously fiscal solvency in the 80s, 70s, when we had President Reagan, who was like very conscious of taxes. In fact, that's one of the stories we tell at our events, that during the 60s and 70s, Ronald Reagan did 2 movies, because after the third movie, he was taxed at almost 90%. And so when we do that tax presentation at the events, I'll ask people and say, 70 to 80 to 90% tax isn't possible, is it? No. And then I see a lot of heads in the audience shake, no way, it's not possible. And then I show the slide that says, well, actually in the 1960s, the top tax bracket was 88%. And so again, just to echo your point, if you think you're going to be in a lower tax bracket, you're really not in retirement. In fact, we would argue that next to healthcare, I think your taxes on your 401k, your investments, your tax-deferred dollars, is probably going to be one of the biggest expenses that you have. And I use the analogy of it's kind of like your deal with the devil. We've all done it. We've all put money into a tax-deferred investment. We've put off paying taxes, kicked the can down the road. But at some point, there's a day of reckoning. And I think in the 401k, the IRA, as you say, they are flawed investments. It's something where you have to take a little bit of time and do some maintenance, pay some tax now, get it out of the way, almost like going to the dentist. Take care of some of that plaque and some of that decay now, because you're going to have a lot of problems later on down in the future if you just put it off. And that's what I see in the government across all the sectors, whether it be Social Security, the national debt. There's just a lot of putting it off, kicking the can down the line. And if you subscribe to that mentality, you're going to be in for a much bigger problem in the future than just taking a little bit of time. Do some maintenance on your accounts, get the taxes taken care of as best you can, and have a better peace of mind going into retirement.
If you were paying attention there, Chas gave you an answer to the upcoming event, the Retirement Playbook. Should you choose to attend next week at BGSU, Levis Commons, it's one thing to take in consideration. We say all the time here, or I say all the time, that you've got a silent partner in Uncle Sam when it comes to your retirement portfolio. If you don't have it tax optimized right now, he is becoming less and less silent. And so, what should you do? Should you go ahead and take care of that right now and make sure you get to keep more of your hard-earned money down the line? Making sure that the tax code works in your favor is what it's all about, and it's all part of that retirement planning process. So, if you want to continue that discussion at the events, again, coming up next week at BGSU Levis Commons, go to arhq.com. Click on the events tab for more information, including how to register. Or if you just want to go ahead and jump in and speak with the team and start developing that plan, you can go to that website as well, or give a call, 419-794-3030.